This is the Equity Management Academy Weekend Podcast for August the 7th, 2021. How high does inflation need to go to trigger the long-awaited gold rush? Mean reversion trading. Summary. A lot of volatility today on the jobless news that came out today. Job growth accelerated in July and the unemployment rate fell. The unemployment rate fell to 5.4%. In response, gold had a massive sell-off. The economic news has brought the issue of tapering back onto the table. A lot of volatility today on the jobless news that came out today. Job growth accelerated in July and the unemployment rate fell. Job growth was faster than in almost a year. Payrolls increased, the unemployment rate fell to 5.4%. In response, gold had a massive sell-off. Gold has broken the support of the variable changing price momentum indicator daily levels and has gone down to the weekly buy 2 level. The fundamentals have changed the momentum of the market after gold reached the high of 1835. We've made 2 or 3 tries into that level. The last time yesterday, when we could not get through that high of 1836. Regardless of the fundamentals, gold came down and supply came into the market. The VCPMI weekly buy 2 level of gold is 1775. So we are at the extreme level below the mean for the weekly data. So we are definitely in an oversold condition. The gold market has come down to this level of support and it is oversold on the VCPMI daily and weekly. It is at an extreme level below the mean. So there is a very high probability that the buyers will come into the market. We want to see the market come back above 1775 and activate a weekly VCPMI trigger. The economic news has brought the issue of tapering back onto the table. The dollar is strong. The stock market is making new highs. We have made a major correction in precious metals, which continue to be in negative territory compared to almost every other asset, which are all making new highs. Even virtual assets are making new highs. For gold bulls, this is a frustrating time because the intermarket relationship between gold and every other asset is completely undervalued. We recommend using 3 levels of stops. The first is the close below at your entry level. If you are using the buy 2 weekly level of 1775, in aggressive trade, we have a maximum loss of 1,000 per position. We are extremely oversold. After the market digests this news, it will realize that it is going to be very difficult for the Fed to taper or raise interest rates in the face of this tremendous debt that is increasing every day. We view this as an opportunity to buy insurance cheap for the long term by getting into the gold and silver. It is only a question of time before gold and silver reflect their true value in relation to all the other assets. Inflation. Trader University recently posted a video on inflation from bad to worse. In relation to consumer price inflation, the consumer price index has had many adjustments over the past few years and probably understates inflation. Even so, the CPI inflation rate is 5.2% year over year. The Chapwood Index goes up to 2019 and looks at inflation by city with a range for major cities from 8 to 9% to 11 or 12%. The University of Michigan produces the Bad Buying Index for various goods. Consumer prices for houses, vehicles, households, durables, all the way up with the rates between 30 and 70%. Off the chart numbers. If you shopped for a new house, car, or dishwasher this summer, you know that inflation is rising fast. The media is focused on arguing that inflation is just transitory. Right now we are at the CPI rate of 5.32%. Even if inflation falls to 2%, it doesn't mean that things will get cheaper, just that they will not rise as fast. Prices are still compounding each year. If the CPI is at 100, it would rise to 105 this year, and then even if inflation is 2%, it would still rise to 107. The number never goes negative because central banks will not allow inflation to go negative. Given our huge debt load, the Fed can't allow deflation to occur. Another type of inflation is asset inflation. When the Fed prints tons of money, asset prices rise. The Fed can't just use their computers to create more money for themselves. They increase the money supply, which devalues the dollar. Then buy bonds and mortgage-backed securities. The Fed's balance sheet has gone from about $1 trillion to $8 trillion over the past few years. Asset inflation is occurring around the world, with real estate up in Europe, Australia, and the Americas. Many people are happy that their home is now worth 30% more, but you are not richer than before because every house went up the same in your neighborhood. You are doing better than a renter. It's not that the real estate, gold, stocks, Bitcoin, and other assets are going up. The dollar is worth less. Its purchasing power is falling fast. When currencies begin to fall, stocks go up. The Zimbabwe stock market went from 400 to 21,000 as the currency went down fast in the past few years. The Venezuelan stock market is up over the past 5 years from almost zero to close to 6,000, which is just the currency going down. The S&P versus gold, not the dollar, shows that the S&P priced in gold hit a high in mid-2000 and fell through 2011, and then it rose a little bit, but it's still worth far less than gold at the S&P high. The S&P is also worth far less today than it was a few years ago when priced against Bitcoin. Gold has an inflation rate of about 1.5%, far less than the dollar. The Fed will continue to print money because the government keeps spending. That cycle is not going to stop. So consumer price and asset price inflation will continue. If so, then gold and silver are excellent hedges against such inflation to protect yourself and your assets.
Are you looking for an automated artificial intelligence trading system? Do you want to analyze commodities and financial markets to determine when to buy and sell? Looking for an indicator to predict future trends in the commodities and financial markets? Welcome to EMA2 Trade Live Signals. Our Variable Changing Price Momentum Indicator, VCPMI, is an automated AI trading system developed and tested over a decade. The VCPMI algorithm is based on age-old vortex mathematics combined with Fibonacci wave theory, trend analysis, pivot points, and several other widely accepted financial analytical methods. The VCPMI can help you take emotions out of your trading and rely on simple mathematics to predict future trends in financial markets. This approach will make your trading more effective, consistent, and profitable. VCPMI algorithm. The VCPMI code points and levels are support and resistance levels and behave exactly like any historical supply and demand level. Therefore, the VCPMI code levels are useful as an index tool for both day trading and for selecting and exercising entries and exits for longer-term traders. Why VCPMI? The VCPMI relies on artificial intelligence to analyze markets and predicts future movements, which seek to determine what a security or commodity is worth at a given point in time. The VCPMI uses technical analysis in the form of mean reversion trading, which seeks to capitalize on extreme changes in the pricing of a particular market based on the assumption that it will revert to its previous state. The VCPMI can be applied to both buying and selling, as it allows a trader to profit on unexpected upswings and save when security or commodity is trading at an abnormal level. Visit ema2trade.com for more details.